When you think of a wedding, you usually think of honeymoons.
Right, definitely.
You think of, like, scouting the perfect venue, debating a DJ versus a live band, and, the cake tasting.
All the fun stuff.
Exactly. It's all romance, all the time. But there is a hidden, distinctly unromantic post-wedding task that, well, if you ignore it, can literally hand your entire life savings to an ex-partner.
It's the ultimate nightmare scenario. And the crazy part is how easily it happens, simply because of a misunderstanding about how our financial system is actually wired.
And that is exactly what we're getting into today. We are pulling our source material from a fantastic guide by Weddizer.
Yeah, it's a really comprehensive piece.
It's titled Adding a Spouse to Life Insurance and Retirement Accounts, a complete newlywed financial planning guide.
Okay, let's unpack this.
Let's do it.
Our mission for this deep dive is to explore exactly why updating your financial paperwork is the ultimate, if, slightly boring act of romance.
Right, the real foundation. We want to decode the underlying mechanics of these accounts so you can avoid the catastrophic mistakes newly married couples make. Because let's face it, nobody wants to talk about probate court on their honeymoon.
Definitely not. And, I mean, it is completely understandable to feel a bit averse to this. You just planned a wedding, which is practically a full-time job.
Well, for sure.
But Weddizer's core philosophy really grounds this whole discussion. They emphasize that a successful marriage isn't just about executing the perfect wedding day. The wedding is, well, it's just the kickoff.
Right.
A marriage is about preparing for a strong, stable financial future together and actively building a fortress around the life you are creating.
So before we get into the weeds of how to actually structure this fortress, we really need to look at the biggest structural flaw people walk around with.
Oh, the will?
Yes. The Weddizer guide drops a massive shocker right out of the gate regarding wills. A lot of people assume that if they go to a lawyer, sit down, and write an ironclad will leaving everything to their new spouse, they are completely covered.
Yeah, that is the most common and arguably the most dangerous assumption people make about estate planning.
It really is.
People think the will is the master document, like the absolute final word on where their assets go. But the reality is that beneficiary designations on retirement accounts and life insurance override whatever instructions you have written in your will.
Wait, I really want to pause here because you, the listener, need to hear this clearly. I am still stuck on the sheer absurdity of this.
It's wild, I know.
Are you telling me that an outdated piece of paper from 10 years ago, sitting in some HR filing cabinet, holds more legal weight than a newly signed, notarized will that I just paid a lawyer $1,000 to draft?
Yes, it absolutely does.
That is just crazy.
It is, but to understand why, you have to look at the historical and legal mechanism behind it. A will is not a self-executing document.
Okay, meaning what, exactly?
Meaning when someone passes away, a will has to go through a legal process called probate. Probate is essentially a court validating the will, dealing with creditors, and eventually distributing the assets.
Right.
That process is public, it is expensive, and most importantly, it is incredibly slow. It could take months, sometimes even over a year.
And during that year, the surviving spouse still has to pay the mortgage and, buy groceries.
Precisely. Historically, the legal system recognized that widows and widowers could not wait a year for a judge to release the funds just to survive. So they created a parallel system.
The beneficiary form.
Exactly. Accounts like life insurance or a 401k are essentially direct contracts between you and the financial institution. The beneficiary form is the mechanism of that contract.
Oh, I see.
Because it is a direct contract, it completely bypasses the probate court. The institution just looks at the name on the form, verifies the death, and cuts a check within days or weeks.
Okay, so think of your will like a general party invitation. You send it out, it says, my spouse is invited to have all my assets.
Right.
And they take that invitation and get in a long, slow line outside the club. That is the probate court. But the beneficiary form.
The VIP list.
Yes, that is the VIP list handed directly to the bouncer at the door. The bouncer doesn't care what your little paper invitation says, and he doesn't care how long you stood in line.
Nope.
If your name isn't on a specific clipboard, well, you aren't getting in.
That bouncer analogy perfectly captures the mechanism. The financial institution is legally bound by that contract.
Wow.
What's fascinating here is how rigid it is. So if you set up a 401k at your very first job out of college and named your girlfriend at the time, and you never updated that form, it does not matter if you've been married to someone else for 20 years and have a brand new will.
The bouncer still lets the ex-girlfriend in.
Exactly. The institution must pay the ex-girlfriend. The guide points out how failing to update these specific forms sparks brutal legal disputes, causes massive delays, and ultimately results in severe financial hardship for the surviving spouse.
It is genuinely chilling to think about a spouse finding that out after a funeral. So if I've updated the bouncer for my 401k and my retirement accounts, am I good?
Well, not entirely.
Because, I mean, if I were to pass away at, say, age 30, my spouse couldn't touch that retirement money without massive IRS penalties anyway, right? Doesn't that leave a pretty big hole in the immediate safety net?
It leaves a huge hole, which is exactly why Weddizer breaks this down into two distinct
Hmm.
necessary categories. You have retirement accounts and you have life insurance.
Okay.
They were designed to do entirely different things.
Hmm.
Retirement accounts, like your employer pension plans, your workplace retirement schemes, IRAs, 401ks, Roth IRAs.
Right.
These are long-term tax advantage buckets. They are generally illiquid. Taking money out early is penalizing.
Which naturally bridges us to the other side of things, life
Oh,
insurance.
exactly.
I think people sometimes view life insurance like, I don't know, a morbid lottery ticket. But the source material frames it very differently. It is not a windfall, it is a mechanism for immediate liquidity.
That's the perfect way to phrase it.
Because it bypasses probate and pays out in tax-free cash, it is the lifeline that pays the immediate mortgage, covers daily living expenses, and pays off outstanding debts. So the surviving spouse isn't drowning in creditors while the rest of the estate is sorted out.
It replaces the economic engine that was lost. If your family relies on two incomes to maintain their standard of living, and one of those incomes vanishes overnight, life insurance is the immediate cash bridge.
Right.
It keeps a personal tragedy from becoming an economic bankruptcy. It can also cover children's education, funeral expenses, and provide long-term security.
So we know we have to name our spouse on these forms to avoid the bouncer turning them away. But how painful is this process, actually?
Honestly, it's quite simple. The source outlines three basic steps.
Okay, lay them on me.
Step 1, contact the provider. You can usually do this online or request a change of beneficiary form.
Easy enough. Step 2.
Provide the spouse's details. You'll need their full legal name, date of birth, relationship to you, address, contact info, and sometimes a form of ID.
Okay, that makes sense. And the last step.
Step 3 is setting your primary and contingent beneficiaries.
Okay, I'm guessing that is the financial equivalent of like a backup parachute.
That is exactly what it is.
Yeah.
The primary beneficiary, usually your spouse, is your main parachute. But if, for some tragic reason, you both are in the same accident or your spouse predeceases you and you haven't updated the form yet, you need a backup.
So they're like understudies in a play. If the primary actor can't take the role, the benefits go to the understudies.
Yes. The source lists common choices like children, parents, siblings, or a family trust.
But hold on, I want to dig into that list, specifically naming children.
Right, yeah.
A lot of newlyweds might have like a toddler and they think I'll put my spouse as primary and my 3-year-old as the contingent.
Oh, yeah.
That sounds incredibly sweet and responsible on the surface. But isn't there a massive hidden trap there?
It is a complete legal landmine. What's fascinating here is how the law treats minors and money. Financial institutions cannot legally hand a check for $500,000 to a 3-year-old. Right. If your minor child is the contingent beneficiary and the money falls to them, the probate court has to step in anyway. The court will appoint a financial guardian or conservator to manage that money until the child turns 18.
And the court might not pick the person you would have chosen.
Exactly. And even if they pick someone you trust, that guardian now has to file annual accounting reports with the court, proving how every single dollar was spent for the benefit of the child.
That sounds exhausting.
It is expensive, it is incredibly restrictive, and then the moment that child turns 18, they are handed the entire remaining sum, no strings attached.
Yeah, I don't know many 18-year-olds who can responsibly manage a massive lump sum of cash.
Not many, no.
So what is the alternative? Are you forced to just leave everyone else out in the cold if you have a complicated family situation? Say, I am coming into this marriage and I already have teenagers from a previous marriage. Or I co-own a highly valuable business with my brother.